Welcome back. We've got Venkatraman Narayanan, who is the Managing Director and CFO, as well as Joseph Anantharaju, Executive Vice Chairman and CEO. This is Product Services at Happiest Minds. Thank you so much, gentlemen, for joining in. Let's discuss the trends and the risk of a slowdown in the US, what your view is on guidance. To begin with, on the latest announcement of the debt raise, walk us through what the funds will be used for and what is going to be the cost of borrowing.
Hi, good morning to all of you. Happy Holi and a happy Women's Day. Now coming to the question, we are raising about 125 crores in all as a non-convertible debenture. The purpose stated is for general corporate purposes. We have about 600 crores with us, a small part of which has been deployed in a recent acquisition. So we are now shoring up our cash resources through a fundraise, debt raise, through an NCD. The rate of interest is Treasury 91-day T-bill plus about 2.3%. That's the likely cost of the raise, which is quite competitive.
Right. You recently acquired SMI as well for about 111 crores. Is this EPS accretive, and what kind of contribution do you expect from this?
Yeah, the deal is absolutely contribution accretive, in fact, earnings accretive. The EBITDA, as I mentioned earlier in certain of my interactions, is 26% plus. They have a couple of large accounts where they focus on within the healthcare sector. So that gets us a good opening into these large accounts that they are working on. And on the margin front, like I said, 25-26% EBITDA is what they do. So from a margin standpoint, they are not at all diluted. So if you see it from all angles, it's an accretive deal.
Yeah, and just to add to that, as we speak, we're looking at a couple of ways to leverage this acquisition further. One is we're looking at how to cross-sell more services into some of their customers and customers they had in the past who probably felt that this was a smaller entity. And therefore, now that we have a larger entity, it gives them that comfort to work with us. And we have several conversations already going on within a month and a half of the acquisition. The second is we're also looking at how to leverage some of the talent that we have especially in Madurai. Right now, over a period of time, we look at Coimbatore also. So we already have a few people from Madurai working on projects that are currently being executed out of Bangalore. So there's synergies already building in along with the margin and other aspects that Venkat talked about.
So Venkatraman, then given that you have 600 crores of cash plus this fundraise, are there any more acquisitions we can anticipate in the pipeline?
We are constantly looking out for acquisitions. As I mentioned in the past interactions as well, we're looking for good companies which have strong digital capabilities or a vertical experience or exposure with good customers. Like Joseph mentioned, capabilities which we can upsell, cross-sell into, or accounts which we can upsell or cross-sell into, or past interactions which we can sell into. So these are all the various aspects that we continuously look for, and we have got a decent pipeline, if I can say that, of acquisitions. But acquisitions tend to be binary. It happens, and there are lots of hoops that you have to jump through before you can call a deal a closed deal.
Right. Venkat, just to get an understanding of how many companies are in the pipeline that you might be looking at to acquire in the future of, if things go fine?
The pipeline is solid. So just like as in any customer acquisition scenario or the way we do prospecting of clients for our business, pipeline is quite deep with about, at any point in time, about 15, 20 companies, out of which we are having active conversations with at least a couple or more. So it's an ongoing process. We have in place bankers who are there on a retained basis. They take us through these transactions. So it's a very regularized kind of a process that we follow with regard to acquisitions and keeping the pipeline going.
So, Joseph, the last time we spoke, you did highlight that there was a slight delay in decision making. What's the update? Is there signs of a further slowdown?
So I think that the conditions that we had a couple of months back, they're still holding true. You have customers even within the same segment who are spending and others who are being a little bit more cautious. Overall, I think as I mentioned earlier, customers are keeping a close watch on what's happening, and also equally important what their peers are doing. Some of what I've noticed is some of the actions taken or some of the decisions or direction taken by a few of the customers is dictated or is influenced by what they see their peers or others in the same industry doing, and that I found interesting actually, because even if the business is doing well or they tend to get a little cautious if they see their peers reacting in a certain way. But overall, I think people are continue to take a close look at whatever investments they need to make, and where they need to invest, they're continuing to invest. So you have to make that value proposition that much more clear, and also make sure that you're in the right areas, discussing with the right folks in the right technologies or business units to ensure that you're able to get these opportunities that bubble up. So that I think is becoming key. How to spot those needs and engage with the right people.
Venkat, margins have been trending for you between 26 to 27%. Is this likely to be the range, or with supply side issues abating, you think margins are likely to trend even higher, perhaps?
Our margin guidance has been 22 to 24%, and last year and the year before, we have held on to that number and kind of beaten it as well. Going into the new year, while I'll wait to see our plans and the numbers that we are putting together and see how they stack up, I would still continue to, I think we'll continue to hold to the 22 to 24 number, because, while supply side constraints are removed, when you look at it a macros perspective, within that pockets of expertise that we look for within with digital capabilities, there is a little bit of tussle for talent continuing on that front. But yes, on a larger front, if you look at it holistically, maybe attrition numbers are slowly trending downwards and supply is getting better. Second thing is, we are slowly getting our pyramid straight. We have hired about 300 campus joinees in the last year. We are looking to onboard about 400 more this year. So that's also bound to have an impact on our margins. And I would like to continue to hold to 22 to 24%, while hoping and trying to better that on a quarter-on-quarter basis.
And Venkatraman, coming back to you, the 9-month revenue run rate has been 26%. Realistically, what will be the FY23 run rate, and what is the expectation for FY24?
Our guidance for the margins was 22 to 24%, and the guidance on revenue growth is about 25% plus. So, as you rightly pointed out, for the 9-month period, our revenue run rate is at about 26% plus. That's on constant currency. And just as we have done in the last 10 quarters, we have beaten the margin guidance of 22 to 24% by a good 200 basis points. And that means we are currently about 25.9, 26 kind of a percentage on that front. Talking about the future, would like to hold on to that, because currently we are going through the internal planning process, which nicely dovetails with our clients, interactions with whom Joseph and the other BU heads are having conversations. So we are putting the numbers as they come together to see how they look, and then we'll come back with what we see as a growth prospect, a growth for the next year.
Right, gentlemen, great to have both of you on the show today. Thank you so much for taking the time out. In the meantime,